The U.S. banking system, the banking crisis. TD Bank in Canada is currently the most shorted bank in the world. What are you conversation-wise having with clients? Like, is this actually impacting your business or what people are doing?
No.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds.
Welcome back, everybody, to another episode of the Tom Storey Show, your weekly Sunday real estate recap show that covers everything Canadian real estate, but today, our first American guest. So thank you for being here. Thank you for listening. Thank you for watching. If you're watching on YouTube and you have not already, make sure to subscribe to the channel. I think we're at like 1,750 subscribers now, Steve. It's pushing. It's growing pretty quick. So the goal is to get to 2,000 by the summer. It is now officially the spring, so thank you for being here. If you're listening on the audio apps, I just want to say thank you. Our audio downloads continues to grow on a weekly basis. We're at like almost 900 audio downloads per week, and we appreciate you coming back here and listening to us every single week. Into today's guest, John Bai has joined us. He's a team leader, active real estate investor. He's been in the real estate industry since 2004 in the greater Seattle market and has helped over 1,200 families, and personal friend of Steve. John, welcome to the show.
Thanks for having me. Appreciate you, fellas.
Well, I want to start. I got a bone to pick with you.
All right.
Ready?
Right.
We're going to start hot. So... You know, I've probably known Steve for 5-6 years now. It's all kind of a blur, right? The relationship's always a blur with Steve.
Yes.
Lots of cocktails involved and things like that. But so many times I've been hanging out and Steve's like, oh, my friend John from Seattle's like my best friend. He's the best guy ever. I'm like sitting there like, what am I, chopped liver? Like, I've heard about you so many times. So it's actually great to meet you in all seriousness. Yeah. And I appreciate you being here. So how do you know Steve? Where did that relationship start?
Oh man, are we going to tell the truth here, or
I hope so.
Okay,
go for
it. Steve and I met like many moons ago, pre-real estate, when we were just youngsters. So we all have ambitions as young men, and they usually involve automobiles. So Steve and I met in a car club. I think I was 17 maybe when we first met. I was pretty young. You know, Steve being Steve, obviously he makes friends with everybody everywhere he goes. Well, come on, man, give yourself some credit. Like, you're pretty
maybe.
Good, so.
Once they get to know him, yeah.
Yes, once you get to know him, right? You got to cut through a little bit.
Yeah.
But so Steve and I met then, and we just hung out all the time. Like, our kind of a friendship bloomed pretty quickly. I wasn't even in real estate at the time when we met, so I was still working. I worked at an auto parts place, and ended up getting into real estate just randomly. And I was starting to see some success, and then I just kept prodding him. I'm like, dude, you got to do this. Like, I know you can make this. And I just kept wearing and grinding on him, and finally got him to take the leap. And Matt, how long have you been in the industry now, Steve?
I am in my 15th year, man. Yep.
Yeah. Ooh, that's a pretty good guess. So, yeah. So, you know, 5, he saw me do it for 5, and he's like, man, if John can do it, I should probably do this too. So, that's usually the motto. But ever since then, it's been great. You know, he's always pushed me to start a family. My wife and I, we finally made the commitment. So our daughter turned 1 on Monday, which
congratulations.
Was pretty exciting. So,
congrats.
You know, now trying to balance being a leader, a dad, a husband, a good friend. It's a whole new journey for sure.
Well, let me know if you figure it out, because I've got a 16-month-old and I'm still struggling every day trying to make this all work. But I've actually, it's funny you say that. I've learned a lot of parenting things from Steve as well, seeing him in action, and I'm learning things. I don't want to skip over this because I only found out about this live on a show like a month ago. I didn't know Steve's car history. And I promise for the listeners, we'll get into lots of real estate today. But going back to those early days, lowrider Steve,
yes.
So John, what car did you have? What did he have? Did you live in Vancouver then, or were you always in the States and then you met through the club?
No, I've always been in the States, and through the club, him and a bunch of guys used to drive down to come to car shows in the States. And so that's how we met. And they ended up starting a chapter of the car club that I was in Canada. I don't even know what year car it was that Steve had. I know it was low, old, and green. It was green, right? The old one that you had, the first one you had, or was it blue? Either blue
When
or
we first met, I bet you I had my '67 Cutlass, and then the '53 Pontiac was the one you're
green. Yeah,
talking about.
that's the one I remember most at first. So, but I had a little S10 pickup. My first house was in the hood, so it was great. So I blended in. I had a little mini truck on little tiny wheels and hydraulics. So I'm always like trying to blend into my surroundings. So it worked out really well. So over the years, I've had all sorts of different cars, fun cars. It's always a passion. You got to have something sitting in the garage. Steve, don't sell your car. You
Yeah,
will regret it.
he's got to get his up and running again. I've seen that thing. Well, I've seen it under the cover. I haven't actually.
Yeah,
I haven't lifted the cover yet.
I've
yeah.
officially become the guy now that I said I would never be, with the car in the garage with like the boxes on top of it. Like everything I hated about all my friends' dads when I was 16, that's me now.
That's you now.
Yeah. For me, it's my favorite thing to go on a listing appointment and I see that car in the garage because I'm like, how can I buy it? If it's halfway decent, I'm going to try to buy that car.
So do you collect cars? Do you have several cars now?
Now I don't, as being a father, and we
Mm.
just remodeled our entire house. So I sold my last car, the one that I had a 60 hardtop Impala. I've had a couple of them, and I sold it because we needed room for our cabinets in our garage. So,
That is such a dad answer. That like, I love it. I love it. All right, so let's jump here to real estate. So walk us through. Me and Steve are very in tune on Canadian real estate, what's going on.
Yeah.
We see what's going on in the States. We know that we basically follow the Fed with interest rates to a point. Tell me what Greater Seattle is doing right now. Are you seeing the resurgence that we're seeing here? What was the pandemic like, the ups, the downs? Like, give us like the last 3 or 4 years.
Yeah. So I think our market experienced very similar conditions as yours did. The Seattle market is very unique and has some similarities to both Toronto and Vancouver because we're surrounded by mountains, water, and the border, right? So I think that we have these little pockets that tend to help with our values because there's just growth issues. I think now we're starting to follow suit a lot here locally, like with what you guys are able to do with a lot more basement suites and detached units and trying to just sock in land. There's stuff going on right now where there's talks about eliminating single family zoning, like in our entire state.
Wow.
Because we just don't have any, they have to find density. So there's lots of talks and things like that. But, I remember when the pandemic hit, we were on, a pretty good trajectory, just year over year, like good gains, high single digit, low double digit gains, like year over year consistently. And I remember when the pandemic hit, and I'm in a coaching program as well. And like all of us get together and like, oh my gosh, like, what do we do?
We're all screwed. Yeah.
We're all like, we can't leave our houses. How do you sell a house that you can't get in? And you try to now we're trying to get creative and how do we do this in a safe way and, respect the situation and all that stuff. And, for the first couple weeks, we're in full on lockdown and nobody really knows what to do. And then you start coming out of that and you go on an absolute tear, like the busiest 2 years of our career, just wild. And the challenge becomes now is that's been so good over the last couple of years. And then bam, the world opens up, inflation goes off the charts, interest rates go up. And I would have to say that transition from such a hot market to a more normal market, like literally within a couple of weeks, like it changed. That transition was harder than the beginning of the pandemic.
Yeah,
Way
totally.
harder.
Because you don't have, when it changes that quickly, it's like you go through a period of time where there's no comparables. There's not enough sales actually happening to make sense of pricing, where it's actually harder to figure it out. Like on the up, okay, the house is going to sell for what it's worth because people will bid it up. But on the down, it's like, well, where do you try to catch the knife? Like, where's the pricing? Where does it make sense?
Yeah. So our biggest goal for all of us on this call too is like setting proper expectations.
Yeah.
And the challenge is setting proper expectations when you have no clue. You have no data. You don't know what's going to happen. None of us have been in this situation. I was doing this 2008, 9, and 10. And that was a whole different beast, but I would say that this market is just as challenging in different ways.
So you mentioned 2008, 9, 10. I didn't sell in that market. I got my license in 2014. Steve, you were at the beginning of that or the end of that, basically, like as it was starting?
Yeah, John thought it was a good idea and encouraged me to get my license December 15th, 2008. So thanks, John.
Hey man, if you can make it then, you can make it whenever. Right?
That is true. That is true. The agents that are starting today, if they make it 2 years, there are agents for the next 20 years.
Absolutely.
So going back to the financial crisis and working through that market, like, can you walk us through, because even what we saw in Canada was not even close to what you guys saw, what happened in 2008. And that was the doom and gloom that I think a lot of people thought this time around was going to be again. It's obviously different this time, but can you just walk us through, like, those must have been terribly hard conversations with sellers. You know, like, did you go through your own personal situation as well? Like, was your family affected?
Oh, absolutely. So, I've noted, like, man, I lost a property during the process. Being an entrepreneur and a young agent and a young man too, like going through that in your early 20s, it was wild. There's definitely a lot of challenges. At one point in time, I had rented out both of my houses and I was renting a room from one of my buddies, a really good friend of mine, in my office. Like, I was doing anything that I could to stay afloat. Then I was pretty early in my career though, so I didn't have a ton of listings. As we all know, usually when you start, you end up helping a lot of buyers. So my listing inventory wasn't crazy and I was able to work through that piece. The biggest challenge though is when you're working with buyers, because at that point in time, I think the highest in our MLS, active at one point in time, we had 36,000 homes for sale in our market.
Oh my God.
Right now, to give you the other side of that, we have about 4,000 right now. So the challenge was that you'd get somebody that was excited about a property, and then right afterwards, the next day, there'd be cheaper, better houses that would come on the market. So you're constantly like rolling in and out of contract because they want to bail and go to this other one. So that was a really big learning curve. But what ended up happening then was, once we started getting out of that, all these big like REITs and investment companies started buying up massive portfolios. And fast forward now to our current market, and everybody, that was the big concern. Are we going to see those inventory levels? Because inventory is really what drives pricing. So if we have a flood of homes that are going to hit the market, then we're going to be toast. But the challenge is that there's so many properties that are owned by corporations and investors now. And if they sell them, where are they going to park the money? They got to move the money to a better investment.
Right.
And there's not a better investment. So we haven't seen tons of inventory hit the market. We're not expecting tons of inventory to hit the market. I've had people reach out lately, like with all the iBuyer deals and Redfin and Zillow and all these other companies that were buying real estate. Like, what are they going to do? Are they just going to try to liquidate all of them?
Right.
And even if they do, though, they're probably not going to piecemeal on the market if they're really in a pinch. They're going to make a call to somebody who's got 2,000 or 20,000 homes already, and they're just going to sell them directly to them and just get them off the books.
Yeah, it's not going back to potential consumers, right? It's going back to other corporations buying their portfolio, right?
Absolutely. So that's been our saving grace. Our market peaked so high so quickly. In most cases, we were, up 60, 80, 100% for some properties over the course of a couple of years. So having a 20% reduction, which we saw kind of across the board in most areas, we had more room to fall because we went up so high. When I talk to my colleagues like in Arizona and other areas, they haven't seen as aggressive changes because they didn't go up as high as we did. And I know you guys experience that all the time, like more kind of violent seesaws than what we see here. Like, it's extreme. When I talk to Steve, he's like, man, the last couple of weeks have been slow. And then the next couple of weeks, it could be like on fire. And then it's slow again. And then it's like freaking, it's just bananas.
My broker of record calls real estate a clumpy business.
Yeah.
It's clumpy. It happens in clumps, and you don't know when those clumps are going to happen. It's interesting you brought up like Redfin and Zillow. They haven't broken into the Canadian market like they did in the American market, but we had a few companies that were doing similar things in which they were buying up properties or guaranteeing, and now they've laid off like 80% of their staff, and it's gone back to this full service model where the traditional, let's call it like legacy real estate agent model, is continuing to hold all the inventory. So
Yep.
is it now that, okay, your market has started to pick up again, but obviously you went through that downturn where the prices went up and then dropped off, and now you're seeing, because of the limited inventory, the consumer confidence is slowly coming back to the market.
Yes.
But now, are you finding that sellers are still wanting the iBuyer because it solves their problem, or they want the real person that's going to buy their house and actually live there?
I would say that there's more real transactions happening now from, not that iBuyer deal, at least here in our area, because people are now, there's not as much meat on the bone, like in their eyes, there's plenty of meat, right? But if you base it off of where you were, you might get that all cash, quick close investor iBuyer deal. It was a good number then, but now it's not. Now you're not willing to take that. That number is not, because now they're not willing to pay the same prices either, because they are looking at the trends and know what's going on. So they can't have that risk.
It's always funny. I've always thought, like, when I meet with sellers, it's always like, who's the unicorn buyer, right? So for properties outside Toronto, it's like, we want the person from Toronto. We want to get that sucker from Toronto to come out and overpay because they don't know the market, right? The people in Toronto, it was like, well, we want the foreign buyer, right? We want the money coming in from overseas because they're going to pay more than our property. But then what I've always looked at too is like the institutional buyers, or potentially the developers, they're looking at it. It's a numbers game to them, right? Where if I was selling my own house, I'd want the emotional home buyer buying it, because a few dollars might show up on the table more because they really actually want this. It's not just a spreadsheet they're working off of.
Absolutely. And that's really the big push, is to get, it's all emotional, right? Real estate's the majority of it's emotional. So, and usually if there's emotions involved, scarcity mindset, people will be willing to pay more in those situations.
Can you run me through what it costs for different asset classes in your market? So in Seattle, are condos a big thing in Seattle?
Not as much as they used to be. So there's everybody that was building condos, especially like 2008, 9, 10, like that was all the rage, like condo conversions, new condos. The challenge now, though, is because our market is so sought after, people, all those buildings that would have been condo sales are now just apartments. So there's not as many, unless you're in the core of downtown, or like, so if you're in like downtown Seattle, downtown Bellevue, downtown Tacoma, those are going to be some marketplaces where you'll see actual condos selling, like in high-rise buildings. But most of the time, those are going to be big, huge rental apartment houses.
Interesting. So they're building purpose-built rentals now, not condo buildings. That's the trend that it's gone to?
Yes, much more. We do see like your luxury condo market, like that's still there. And we're seeing some of that start coming back a little bit more. But there's definitely less cranes in town than there was before. Before it was like everywhere, and there's still plenty, but I feel like it's not like it was.
And is that because homes are still kind of affordable for people, that they don't have to buy the condo? Is that what's happening?
So, yes, you can get outside the city and, take transit or commit to a terrible drive and get something that's actually affordable.
Right.
It's funny.
What's a terrible drive in Seattle or outside Seattle?
I would say if you're commuting into anything over an hour, in my opinion, I think is terrible.
But much like Toronto, Tom, Seattle traffic can be like, I just went down, saw John a couple weeks ago, and let me tell you, it was like 2 hours from my office to like North Seattle, and then like an hour and a half to go that extra like 15 miles. Right. So it's very much like Toronto. If you get on the 405 or the I-90 in the wrong time of day in Seattle, man, it's just parking lot.
It's like the 401 here. It's just bad traffic always.
It's like that stupid expressway thing you guys have, except Seattle was smart enough to take their whatever that elevated expressway was down. What was it? The viaduct?
Viaduct, yeah.
They took that thing right down. So, John, just so you know, in Toronto, they, instead of taking it down and doing something else, they elected in Toronto to try and just put some patches along that thing.
Honestly,
and it was built around the same time.
It's like I drive under it on Lakeshore all the time, and when I'm stopped, I look up. I'm like, this thing doesn't look safe.
It does not look safe.
This episode of the Tom Storey Show is brought to you by the YouTube for Real Estate video course. Are you interested in creating an engaging, value-driven YouTube channel to help educate your client base on real estate in your market, as well as introduce a new revenue stream to your business? Perhaps you've already created a YouTube channel, but are struggling to gain viewership and the subscribers you are looking for. The YouTube for Real Estate course will provide you with proven tips and strategies on how to create and cultivate an engaging YouTube channel, as well as how to optimize your channel, resulting in higher viewership, subscribers, and yes, deals. But that's not it. I implemented YouTube in my business in early 2021, and it has easily been the best marketing source for meeting new clients that I have ever had in my business, period. Better than expensive geo-farming, internet marketing, and open houses combined. And now it even rivals my repeat and referral business. If you would like to learn all the tips and tricks for meeting new clients using YouTube, simply go to Video Course Login or click the link in the description below and sign up for the YouTube for Real Estate course today and learn a year's worth of my painstaking research of learning how to use YouTube for real estate in just a few hours by taking the YouTube for Real Estate course. So go to videocourselogin.com right now and use the promo code TOMSHOW at checkout. Again, that's videocourselogin.com or simply use the link below.
It does not look safe at all.
Very, very scary looking. So what is so run me through the numbers on like, okay, I want to buy a property in the main market that you sell in. What is a single family detached home, 2,000 square feet or 2,500 square feet?
Yeah. So like just kind of like suburban outside the city. So we're about 15 minutes kind of south of downtown, 15, 20 minutes with no traffic. So depends on, what you got going on, but you're looking, you can be under $1 million all day long.
Oh, okay.
Oh yeah. 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 So I showed Steve this house when he was in town, a little one owner, old home, very similar to homes that both Steve and I had lived in like back in the day. And we sold it for $475, and Steve's like, man, in Surrey, this would be like $1 million.
Well, with our exchange rate right now, it's not too far off.
It wasn't actually that far off. That was the interesting thing. So like that was a busy street, right?
Yeah.
There was a couple of things going on with it, but I was sitting there looking at that house going, this is at least in the worst areas where I am, this is a 950 house. Like This is probably over $1 million. Because it says 3-bedroom, little rancher, 5,000-6,000 square foot lot, whatever. And then I was like, okay, so then when you do the conversion, like our dollar stinks, man. I just bought something in American dollars the other day online, and I forgot how bad that conversion was.
Would 450 American be like 600 Canadian right now?
Yeah, 650 by the time you're done. So it's like if you're 475, yeah. So like, but the difference there is I don't think people in this community where I am would really want to live in that style of house anymore. We're so much bigger. You guys have both been to my place. Like that is the average house now is 4,000 plus square feet.
Yeah.
And when you go down to Seattle, like Toronto is strange a little bit because everything is like these really skinny 3-story houses. And then in Seattle, it's the exact opposite. It's like this little flat pancake, right? Little tiny house on a lot. So you get a lot more of those kind of rancher style, maybe post-war homes in Seattle. And that's much more of the regular that you see on the side of the road, as opposed to here where we're a lot newer. Anything that old here is torn down. Nobody's interested in living in that anymore.
And if you're in different areas, like that's for sure the thing. So if you get, especially outside of Bellevue, I would say it's more probably similar to Steve, what you experience a lot in your neighborhood now is those smaller ranch style homes. And then bam, there's a, 4,000 or 5,000 square foot house on it. They buy the dirt for, 1.5 and then they build a house that's worth 4,
Wow.
at the end of the day.
So you guys have the luxury market too. You've got the big ones as well.
Yeah. Oh yeah.
Interesting. Okay, so sorry, go on.
Oh no, I was saying, like, us in our business, like, we don't like I wouldn't peg us as a luxury agent or a first time buyer team or a move up team. Like, we're all referral based, so we help everybody. I remember a couple years ago we sold a $4 million mansion and a $40,000 mobile home in the same month. And for us, it's like, hey, our people need help, right? They're coming to us for guidance. Obviously, there's a different plan in place for each one of those products and how we're positioning them and going to market. But we help everybody. So
I'm willing to bet you worked harder on the $40,000 sale, right?
no, I did not on that one. But it doesn't. But sometimes it goes that way. Definitely. Sometimes the smaller price points can be a little bit more challenging. But I remember, like, even the thing for me is I really appreciate doing that type of stuff and that kind of work and helping those clients, because it's all a referral based business, and you help somebody with whatever they need, they're going to come back to you time and time again with more needs in different arenas and friends and family and the people in their circles. Like, that's what it's all about.
Our version of that is like doing leases, right? And Steve can't do it in his market, but I built my entire business in downtown Toronto leasing condos. I think I did like 60 or 70 leases my first year, built my database. I got to the point that I would walk in and like know the concierge and all the buildings by name. And I was like, and I knew the floor plans and the buildings, and it built me so much confidence by like doing that, having that opportunity. And then, fast forward 10 years, they've all bought several times and moved around and referred their friends. So yeah, totally agree. I want to bring up a topic that is a big topic going on in your country right now. Nothing to do with presidents. We're not covering that. Not that topic.
Yeah.
The U.S. banking system, the banking crisis. A lot of people look at what happened there with the two banks that had it happen, and even there was an article recently that TD Bank in Canada is currently the most shorted bank in the world, which is where I hold all my money. I was like, what's going on here? Figuring out how much insurance I had on every account. Can you just walk us through like we know what happened, but what are you conversation wise having with clients? Like, is this actually impacting your business or what people are doing?
No.
Okay.
Yeah, I think that it's a hot topic, and I think ultimately there's always going to be something in the news people are going to gravitate towards, see how it impacts. Is it making a big difference? I think for sure there's some folks that it's more prevalent on their mind than others, but a lot of our clients, especially in this marketplace right now, are moving because they have to move. They're selling because they have to sell. The banking industry doesn't really matter. Like, they need to sell this property because they're moving out of state. Somebody passed away. They're getting a divorce. There's a life change. They got a bunch of kids now, and they're in this small little rancher, and now it doesn't work, right? They're going crazy. So right now, that's a lot of our client base. So it's important to know what's going on. So when people ask you questions, but when it comes down to the nitty gritty of, am I concerned with my money and where it's at? Am I making a run on the bank and filling up my safe full of hundreds and like waiting for the apocalypse? Like, none of that's happened. By the way, though, you should have some cash like in your bank or in your safe for sure.
Okay.
Yeah. A little bit, but it doesn't have to be all of it, right? We got to source these funds to buy your house. Mattress money don't count. Okay? Trouble. So.
Okay, so then keeping on with the banking system with the Fed. So can you walk us through, as Canadians who don't really watch exactly what's happening, we have an idea. What is, and actually, I think this would be cool actually to explain to us, I have a pretty good idea, but to the viewers, how U.S. mortgages work, because it's way different than what we have here. Right now, so where was the rate at in the middle of the pandemic when the rates had dropped? Like, what were people buying houses at? And then where's it at today? And then let's talk about how the mortgages actually work there.
Yeah, absolutely. So we were high 2s, low 3s.
Okay.
And now we're mid 6s.
Wow.
So that's a significant change. The one thing, though, is that people that we're constantly educating on, though, that doesn't mean that your mortgage is doubled, though. Like from a consumer, a lot of people are like, twice the rate, twice the price, twice the payment. Well, that's not the case. So you got to go through with each person on a little bit. Obviously, we team up with great lender partners to be able to have that more in-depth conversation, but you have to have a little bit base knowledge to be able to make sure that they're not getting totally freaked out. So, because yes, it's going to be more expensive, but the great thing is it's different between our markets is that you guys have to refi or change your payment's going to change every 5 years, no matter what, right? Or whatever your terms are. I think it's flex.
Pretty
like maybe
normal.
10-year max.
Normally it's 5 years. Yeah.
Yeah. So for us, we lock in for 30 years, right? There's other products where you can have adjustable rates that are on like 3, 5, 7, 10-year terms that then go on an adjustable schedule afterwards. So some people use that strategically if they know they're not going to be here for a long time.
Right.
And if the rate's going to be significantly less, it might make more sense to get into that type of a product because you know either you're going to refi, you're going to sell in a couple of years and move out of the area. So there's a handful of different ways to look at it. But for us right now, it's like your mortgage payment is not going to be awesome right now.
Yep.
But the beauty is that rates will go down at some point. I don't know when, and it's probably going to be in the next couple of years. They'll kind of get back down to where we were pre-pandemic, high 4s, mid 4s, maybe low 5s. And that's probably where we'll stay for a long time. Once we get back down there again, I talk to clients all the time, like, you're never going to see a 2 again. You're most likely never going to see a 3 again. And the challenge is if we do see those numbers, our world is in turmoil.
Right.
Right. So I would rather have reasonable rates and some steady growth as opposed to low rates, volatile market, volatile world. And in that low rate environment, you are always going to pay way more money because
walk me through this though, John, for a sec. So if I take a 30-year at 6.5%, and in 2.5 years from now, the bank is offering 4.75. Now, what do I do to get that? Because here we have these massive penalties, especially in our 5 big banks. We have these massive penalties attached that if we want to refinance that, we got to pay a bunch of the interest anyway. So it doesn't make sense to refinance it.
We don't have that. So on the flip side, though, is you have to re-qualify for the loan, though. So that's the difference that you guys have is they're going to change your rate, but they're not going to go through and scrutinize your finances again to be able to continue to keep that mortgage. So that's the challenge here is that for folks that want to get that lower rate, let's say that your financial position is not in a good place. You're stuck. You're going to have to just tough it out. So that's kind of the difference. So you have to go in and you have to make sure that you still got a job and you can still afford it.
But there's no massive penalty or anything if I want to refinance or any fee to the client if they can go from like let's say for instance I can go from a 6.5 back down to a 3.5%. I could just negotiate that as long as my income and everything works.
Yeah. So you're gonna pay closing costs again. So you're gonna pay probably 2% to be able to do that. So you're gonna have to pay all your lender fees, broker fees, appraisal fees, like you're buying the house again, essentially.
Oh, okay.
You update your tax, all of your accounts for your insurance, your property taxes, all that stuff. So there's costs involved in doing that.
So it's not nothing, but it's still way less than we have to do.
Yeah.
Yeah.
Back in 2008, 9, and 10, what was happening is that you would get like 80-20 loans or 100% loans, interest-only loans, or you had negative AM loans. I bought a house once where there was negative AM. That was not smart. So it was like super cheap, and then they would tack principal on top every month. It was crazy. They had so much stuff. But also then, too, you could just be like, I'd like to buy this house, right? Fog up this mirror. Here's your money. It was like too easy. It was crazy. And that's how we got in trouble, right?
Yeah.
But for now, so we did have in that environment back in the crisis, we did have like prepayment penalties. So if you sold within the first 2 years, then there would be a fee for that. Now there's not. The challenge though, is that it really is a challenge for the mortgage company because they get penalized if the client refinances or pays off the loan within 5 months usually. So because the mortgage company gets paid when that loan is given out, right? The mortgage broker gets paid, the company gets paid, all that stuff. but they have to have a certain amount of time to recoup all their costs and the client's interest payments. So if they sell within that time, they go, hey, Mr. Loan Officer, sorry, today's not your lucky day. You know, Mary and Joe Smith just refinanced their mortgage or paid it off 3 months afterwards. We're going to ask for some money back.
Interesting. Wow. Okay.
Yeah.
So it's not as simple as just, I'm just going to change my rate now. There is things that you have to be aware of, but it still seems a lot easier than it is here where you're paying, especially on our price points, you're going to pay like a $30,000 penalty to.
Well, yeah. And the thing for us too is that it's we go in with the worst case scenario. The challenge for you guys that you go in and you're like, man, I'm at the best case scenario, but unfortunately in 5 years from now, I could be in a more challenging position. And that is tough from a financing and a budgeting perspective.
Yep.
That makes it really hard, especially for a young person, like getting their first property when you're like already freaking,
So that's because, like I can hold this mortgage now for the full
for 30
length
years.
For 30
Right.
years. So you're going, okay, it's not going to get worse than this. And that is probably the big difference. I wonder if that's a difference in consumer sentiment in Canada where it's like, oh crap, what if in 5 years I'm in a way worse shape? Like, I think if the Canadian government really cared about homeowners and consumers, they would offer, let's say 10, there is a 10-year rate, but nobody takes it because it's so absurd. Yeah. It's like 7.5% right now or something. But these penalties are crazy, and it's a massive cash cow because it's something like 60 or 65% of properties don't go to their 5-year term. They get sold, they get refinanced, they get something, and then everybody is just hit with these crazy penalties that they weren't expecting. So I think that's something that could definitely be addressed. But we all know that necessarily that may not play as well with the banks, in the lobby groups. So I'm not going to hold my breath for that one.
John, I got a question for you. So if let's say, okay, so a lot of people maybe were already in that 30-year term and they had a rate 2 to 4, whenever they got it, right, at some point in the last decade. Now, on the flip side of things, now because they're not feeling the new rates, right? Only the new buyers are feeling the new rates, hoping that in the future they drop down and then they can refinance. But does that cause people not to sell their properties and then cause more of an inventory issue? Because why would I move if I've got such a good rate? Or can you port the mortgages? Like, what does that look like?
Yeah, so that's another challenge, right? A huge challenge for us. So I heard a stat the other day that in the U.S., 30% of the properties in the U.S. are owned free and clear. So there's no mortgage at all. And of this remaining 70%, 80% of those folks have a rate under 4%. Why? You're not going to move.
Right.
Like, why would you? Like, unless you have to, right? Like, that's the thing is that it's life events that people are moving for right now. They're not buying their dream home unless you still can take advantage of those type of situations in some aspects, but most people are staying put. They're like, I'm just going to hang tight. I don't want to buy a little bit more house and pay way more, or like buy the same house for more money. It just doesn't make any sense.
We have like where you can take, let's say you got 2 years left on your 5-year fixed rate mortgage here. You can, if you sell your property and buy a new property, you can port the mortgage within 90 days usually to line it up. But then if you need more money because the mortgage isn't enough to cover the next purchase, we do like blend and extend, where they'll give you more at a new rate and kind of push them together. So if someone did have a life event, but there were 25 years left on their mortgage at 3%, can they sell the house and port that mortgage to the next property? Is that an easy process or no?
That's not a thing.
Interesting.
Wow.
Not a thing.
Okay. So that's
no porting. You can, there is some government products like a VA loan, which is a veterans loan, or FHA loan, a government-backed loan. And they do have some products. There are ways that you can actually take over that mortgage, but it is so rare. At least here in our market, I think in other parts of the country, people have been doing that more frequently. But here it's not a thing at all. And it's very challenging because then there's all sorts of things that you have to tack on and processes. And most of the agent community is not really savvy around it. And it's just not commonplace.
Right.
So trying to market that opportunity, because essentially what you would do is, as a seller, you would try to advertise this lower rate and having them assume that mortgage. But then you got to make sure the buyer can qualify for that mortgage, and there's all
Yeah.
sorts of things. So it just is more of a headache. And our demand is so good, if it ever gets crazy, and everybody will get creative and we'll figure out whatever you got to do to sell houses, but we don't have to do that right now.
Because you guys have already done that. Tom, this is the part that you probably can't imagine. But when I was new to the business and I was listening to what John was doing down in Seattle, like for 3, 4, 5 years, they were doing just short sales almost. Like
Oh, yeah.
they were doing like continuously, they owe 400 on the house. The house is going to sell for 225. How do I put that deal together? Now
How do you put that deal together? Can you
So
explain that to me?
Hang on one sec. Hang on. I've done this 3 times in my career where we're short by like $3,000 or $4,000. And that was a process, but I do know how to do it. Now, what John has to do, and I'm sure going to elaborate on this, but this is my outside view of this, is basically as the listing agent now, you need to convince the bank and walk the bank through the process all the way to closing to convince them it's a good idea to take the loss. Is that how it works, John?
That, yeah, essentially is how it worked. And the process was just brutal. So it would take, a fast one would be like 4 months if you were lucky. But the challenge too then usually is you had multiple lien holders. You had a first lien holder and a second lien holder. So a lot of the times you were negotiating with the second to do a very reduced payoff, 10 cents on the dollar. And then sometimes you then would also have to dig into the first mortgage too to try to get that reduced. So for a while, I was doing that personally, and it was brutal. What ended up happening though is there was so much of that going on, is another business got created, and there was short sale negotiation teams that you would just pay for that service, and that was their job. So you would pay a flat fee or a percentage of the sale, and they would get compensated at closing for working through that process, because you could be on the phone all day long on hold, right? Like you'd have your phone on hold and you'd be making calls, doing your thing. And then once somebody picked up, you try to move the needle a little bit. But that was just how we did business for a long time.
This episode of the Tom Storey Show is brought to you by Karrasch Real Properties. That's right, my co-host Steve runs an amazing real estate team in the Fraser Valley. If you're someone looking to get more insight of what's going on in the Fraser Valley real estate market, I would highly recommend reaching out to Steve and his team. They're going to tell you what you actually need to hear, and they're going to exceed your expectations all the way throughout the transaction. I've met Steve and his entire team in person, and they're all people that are really, really passionate about what they do. And a lot of their business comes from repeat and referrals, so it's no surprise that they've continued to be in the top 1% of the Fraser Valley Real Estate Board for many, many years. They service Cloverdale, the Fraser Valley, and Surrey, and they know what they are doing. But don't just take my word for it. They have over 95-star Google reviews online. If you're looking for good advice that's not salesy with real people delivering really great results, I would highly recommend reaching out to Steve and his team. You can find them online at krproperties.ca, or in the show notes. You can go in there and you can book a call directly with Steve or someone on his team at a time that works best for you. If you're looking to buy, sell, or invest in the Fraser Valley, Cloverdale, or Surrey, I highly recommend Karrasch Real Properties. And now, back to the show. Wow. Yeah. I mean, that's nothing I've ever, and in that scenario, everyone's losing money. No one's happy. Like, that's got to be so difficult.
It's interesting because the property owners usually weren't happy, but the crazy part is we would have people that would live in their house with not making mortgage payments. Because it takes unreal. Like, I know people that stayed in their house for multiple years without paying any mortgage. And then they would get a short sale at the end. And a lot of the times too, if you do a short sale, it's better than a foreclosure, because a foreclosure super impacts you can't buy for 7 years after a foreclosure. After a short sale, it's 3 years. So they wouldn't pay for a number of years. Then they would negotiate a short sale, and then they could go buy another property in 3 years.
Now, how could they go 3 years without paying? Was it because there was so much of this going on? The bank was like, we don't have the resources to deal with all this right now?
Yeah, we don't want more. We can't handle more real estate, because if they take it on, they don't want it. So now they would have to go to auction. If it didn't sell at auction, then they'd have to hire a real estate agent team to help them then sell the property. So there's this whole other process and more fees involved for them if they take it back. So that's why they were really open to doing the short sales, because they were getting the prices of what people were willing to pay today. So ultimately, they would just end up more than likely at the same price. But now 6 months later, with all this carrying cost and in a declining market, it might even be less.
Have you done a short sale in the last 5 years?
No.
Okay.
There is now we're actually, it's interesting though, now we are seeing a little bit, like a very, very small amount, but every now and again on a listing, I'll see that it's a short sale. And that's really the challenge there, is the folks that got into a tricky situation over the last 2 years. And let's say they overpaid, because a lot of the times you could just, even if your finances changed over the last couple of years, you could just sell, make
Right.
money and go rent an apartment. It's no big deal, right?
Yeah.
Now, if you bought at the tippy top and you need to get out, you might be close, but you're not going to be able to bridge that gap after your cost to sell.
Because like, I guess the two situations for buyers recently is if you were a buyer that bought at the tippy top, but hopefully your finances are still in check, but you got a 30-year 3%, 3.5% rate, let's say at the very top. Is that where rates were at the peak?
Well, like at the peak, rates were, like high 2s, low 3s.
Okay, so let's say 3% 30-year rate. So what's happened since, even though the value of your property has gone down, at least you still have a payment that is reasonable because it's over that period of time. And then you're okay because of that, hopefully, right? Hopefully you're okay. Some people won't be. And then on the other side, it's like, okay, the people that sat on the sidelines and waited and weren't a part of this, now they're getting into the market at a much higher rate, a lower sale price, but it's still the payment's probably more than the person that paid at the peak, but then they're hoping that on the back end, they can then refinance. Is that kind of the mindset?
Absolutely. Because you can't change your strike price, but you can change your rate, right?
Yeah.
In time. So that's right now, that's really what folks are looking at and how we're counseling through, is like, yes, you're going to pay a little bit more, but you just got to power through for a little while. It's not going to be great. Just, don't go to Starbucks every day. Maybe you can't go on a date night. You got to take one off the table once a month or whatever, right? You can be, the amount of waste that we have is just ridiculous. Like,
Yeah.
we all spend so much money on stuff we don't need, and it's a lot of fun. But ultimately, if you can just rein it in for a little while, it's worth it.
I want to tell my story about how expensive stuff is getting in Seattle, because it's just as bad there as everywhere else. So John took me to a Kraken game. By the way,
I was going to bring that up. That was on my list. The Kraken made the playoffs. Congrats.
Yes.
It was very interesting. The refurbished Key Arena, I don't even know what it's called anymore, some ridiculous name, is a way cooler arena than Toronto or Vancouver has.
Well, is it not brand new?
It is.
No, they refurbed an old crappy building.
No, I think that's just the name of it.
They kept the roof. That was the only thing they kept. Everything else is brand new.
Yeah. But it's cool and it has style. Except, which every other, like, I've been to other arenas and they are cookie cutter as can be. So Seattle did a great job there. It's funny because they're all still happy and excited to have a team and they're not bitter yet. But
just wait.
Just give it some time. But we went there and we're standing in line for like a hot chicken sandwich, which was amazing. And I look over and they've got all these just drinks for sale. And a Coors Light, which is my go-to, is $11.99 for a tall boy, which is fine. I was like, okay, not terrible. The bubbly water was $8.99.
Cheaper to drink the beer.
It was, I mean, at that price, I'm not going to go for the better, healthier option.
Yeah.
Right. Like, it was literally sparkling water was $9. And I was like, okay, we're drinking beer, John. Let's go. And then the Kraken won. So that was good.
Yeah. John, if the Kraken get to the Cup final this year, as a Leafs fan, I can't take it anymore. Watching Vegas like start a team, get to the finals in their first year. And you know what's actually kind of hilarious? This is way off topic. We'll get back here, but because the Penguins didn't make the playoffs like literally yesterday, the first time in 16 years, now the two teams with the longest being in the playoffs in a row is actually the Leafs and the Bruins. But the Leafs' success in the playoffs is obviously not there. So I'm just hoping for a miracle this year. We'll see what happens.
Yeah. I'll just be excited if we make it out of the first round. I'll call that a win. So.
Me too, man.
But
okay.
as Steve said at the game, though, he mentioned is we do have to figure out, we need to make sure that, I don't know if Steve said this, but we need to make sure that we can figure out how to be playoff fans. And I'm interested to see how that happens, because there's still the 2 minutes left. It's tied up and everybody's sitting down scenario all the time. And you stand up and get excited and everybody's like, it drives me crazy. I don't.
They should give them little like I was just in Europe and we would do walking tours and they would like tell us in our ear what we were supposed to do or what we were looking at. I actually noticed I was watching a Monday night hockey broadcast and it was the Leafs and it was weird. I'd never seen this. They were literally putting the players' names on the top of them like a video game. And I'm like, oh, I guess they're showing the fans who that person is. I've never seen that. Maybe that's an American thing. I don't know. Or a Seattle thing. Yeah.
Yeah, I don't know.
Okay. All right. Back to real estate. Can you explain to me and Steve what escrow is? Because it's very simple here in Canada. We agree on a price. There are conditions. The conditions are met between 5 and 10 business days. There is now a firm sale. And from that date till closing, it could be 60 days, 90 days, 120 days. It's done. It's closing 95% of the time, unless there's issues. Is that the case with you, or do you go all the way to the closing date?
Nope. So it's a little different. So, and I think that really factors into pricing because, and correct me if I'm wrong, but after you guys go firm, you broadcast the price.
Which I think is silly, but yes.
Yes. So for us, so once you get under contract, our normal time frames are 30 to 45 days from accepted offer to closing and somebody's moving into the house, right?
Yep.
So our timelines are definitely a lot faster. But once you go under contract, our due diligence timeframes are kind of vary. So you have an inspection time frame that's usually 5 to 7 days, and then you have a financing contingency that in most cases survives the entire contract. So let's say that Tom, you're like buying this amazing house and you lose your job 10 days before closing. You can no longer afford the property because you don't have a job. You have a denial letter from your lender. You send that to the agent, who then sends it to the listing agent, and you get all your earnest money back.
So that's crazy. So you get your deposit back.
Yes.
All the way till the day. Now, what percentage
unless it's negotiated differently.
How often does that happen?
Not very often.
Okay.
Very rare.
Something that I see as well, and because I've had some American clients as well, and actually we just sold a client for a guy from New York, and he was like, "Well, tell them to send their best and final by Friday at 2 p.m." I'm like, "It's not like kind of how it works here, right? Like we have an offer that's valid till this amount of time." So when people say cash offer in the States, is that offer now held to a higher standard because they don't need the financing? Because for us, it's kind of like, yeah, that's great, but as long as you're pre-approved, we don't care where the money's coming from.
Yeah. So for us, it's all about risk mitigation, right? So for our clients, so the cash offer just takes all the lending potential challenges or the loss of job or the fiasco at the end. It removes all of that. So it's definitely a lot less risky to take that type of offer. And in a lot of cases too, because there's no bank involved, like, we can close cash deals in 10 days and like you can move into your house in 10 days.
How do you verify the cash though?
So bank statements.
Okay.
Is usually
so you have to send that over with the offer or the contingencies?
Usually you'll have like a 1 to 2 day. It depends on how strong you want your offer to be, right? If it's a multiple offer situation, like I want to see your bank statement, like with your offer, like redacted account number and stuff like that. But make sure that you have the money. But a lot of the times it'll be like 1 or 2 business days to be able to provide your evidence of funds. So, and that'll usually come directly from their banker. So it'll be like a statement on a letterhead that says, Mr. and Mrs. Smith have in excess of over, $1.5 million to buy the property at XYZ or whatever.
Because I was thinking, like, if they shared their bank letter and they had more money in their bank than the purchase price, like, I always find it funny when other agents call me on one of my listings and they're like, tell you like, oh yeah, money's not an issue for us. I'm like, thanks for telling me. Like, now we'll negotiate
Yes.
you higher.
Yeah, thanks for putting all your cards on the table.
Yeah.
So there's absolutely some strategic stuff in that place. You know, when we're working with the buyer, right? Like,
Yeah.
I want to make sure that I don't really want to have that verification of funds because they're more than likely within the offer because they're going to have more. And if you just give me your bank statement that shows you have $1 million and we're writing an offer for 800 and maybe that's under the list price, right? I don't want to do that. But on the flip side, if it's a multiple offer situation and I want to show that our buyer's the best, like I want to show that money's not an issue. And I might show they got $5 million and they're buying an $800,000 property, right?
Got it. So it depends on the situation.
But it's way cooler to know that you're like what you're working with. Here, we're just, I mean, trusting the buyer's agent that they're working with somebody that they've pre-qualified. We have no idea. Like, I don't know, subject to financing. They say they're 20% down. That's my number one question is always, okay, cool, they're 20% down. Which bank are they talking to? And that in that next millisecond is where I know whether or not this deal's going to come together. Because if they're like, they're with my broker, his name's so-and-so, whatever, fine. And they're like, I think maybe it's Scotiabank. It's like, oh, okay, well, we're not going with you now. Right?
Yeah.
Like, at least become a good liar and let me know what the heck's going on because you're not doing a very good negotiation here. I have no idea. And right now, this is scary for us. So, not pending contracts, but let's just say written contracts and firms. So we've written only, I think it's like 20 deals this year. 5 of those have not removed conditions. So that's 1 out of every 4 contracts written is not firming up right now. And that's the highest number I've ever seen, which is absolutely crazy. And it's generally speaking our listings and somebody else's buyer.
Steve, that's the difference between your market and mine, though. Like, I don't know what it is because I'd say more like 95% of ours work out when they go conditional. But like, and the other agent's like, yes, they are pre-approved from this person, where in your market, I don't know if it's like offensive to ask your buyer if they've gone to the bank yet or whatever with the buyers that are coming in on your properties. But that's like, we're not showing you a property unless you're pre-approved.
Yeah.
It's pretty clear. And no one's like offended by it. Is it like a cultural thing maybe for some markets?
It must be just inexperience. Maybe the agents, they're just working with whoever they can work with. Like, yeah, tell me you can buy a house. Yeah, sure. And then they find out later on. John, I don't think we figured out what escrow is yet, though.
Oh yeah.
Yeah. So, well, escrow. So there, I know, like totally went the wrong direction there. But just real quick on that topic, though, for us, we have to have pre-approval letters from a mortgage company that will state how much their down payment is on their letter, and that's been verified. So for us, we don't have an issue there. I don't need to hammer on like where it's from, as long as the lender says it's there and it's on their list. Like they cannot lie on that piece of paper. So.
Okay.
For us, that gets us through that piece. But so the escrow is what happens for us is that once we go under contract, we have a third party that handles all the money, all the signings, recording the property. You guys use attorneys more than likely to be able to facilitate that. We just have a third party company that does that. So the earnest money goes to the escrow company and that's held in their trust account. And then that third party signs and makes sure the title is clear, all the conditions are good, gets all the information from the loan officer on like balancing out and stuff like that. So
escrow is just basically a closing company.
It's just a closing company. Yeah.
Oh, okay.
And
you guys should use that term because now I know what the heck it means.
It's just a closing company.
Well, even if all the deposit funds go to the escrow company, like for us, the deposit funds go to the trust account of the listing brokerage.
Yeah.
So that's how it used to be for us too. Like back in the day, it was either does it go to escrow or does it go to the listing firm's account? And the thing is that I feel like that was just essentially a money grab for brokerage firms, right? Because you have this big trust account.
You're earning the interest.
Now you're making money. You're making interest. So you might have like, $500,000 in this account that's got everybody's earnest money deposits in there that you're getting paid on, right? So I think that was initially probably why they did that. But then they realize that there's more risk holding on to that. And there's just a lot more risk. So they're like, let's just put that risk off. It's not worth the whatever interest you're making on those funds.
So in a transaction, is there 2 escrow companies, one for each client, or is there one escrow company?
Just one, and it's usually dictated by the listing firm. So whoever's listing the property, like we'll say we're going to use this company, and then they'll come in, and when they write their offers, they'll 95% of the time they'll put in the company that we specify. Every now and again, if it's like an investor deal or like a land deal, some of those buyers have like really good relationships with people already. So sometimes we'll use their company that they would prefer in certain cases. Or if some of our clients, they might have friends and family that work at a escrow company and they just want to be able to give them some business. So if the client says, hey, we want to use so-and-so and it's not our preferred person, we'll do that.
Steve had told me that you do the news all the time. So I wanted to kind of wrap up this podcast to hear, how did that start? You've got your own morning news show. Is it like a local news station in Seattle? Like what's going on there? How's that all working?
So I used to do a bunch. This was like pre-COVID. Yeah. So once COVID happened, now they don't really do in-person news stuff anymore. It's like, it's just not a thing. So it was on King 5 News in the morning, and I did it for a couple of years. I would go in every month for like a weekly or a monthly update. And it was just an introduction from a good friend of mine. He was friends with the news anchor, and now I've become really good friends with the news anchor. So he's always like, so now I don't come inside a lot, but for like outside pieces, or if there's other anchors that, want to interview me and stuff, I do it usually a couple times a year. But it was a lot of fun going in. I know you go on the news quite a bit, Tom. But are you in person or do you do it on Zoom?
These days, 90% are Zoom. I did get to do one in person recently, which was like nice to feel like you're like looking someone in the eye again. But yeah, a lot is FaceTime or Zoom.
Yeah, the in-person stuff was super fun. Seeing behind the curtains of how it operates. Like I would go in, my spot would be at 7:10, and I would go in and I would literally be there by 7. I would go in, I'd be in the back, I would go out, I'd say hi to everybody, I would go on air, and it'd be like 2 minutes, and then I would say bye and I would leave. It's like the wildest thing in the world, but it was a ton of fun. And I hope that, maybe sometime I'll be able to get back to it, but it was cool.
There's something about being live on the news that I don't know if I can compare it to anything. Like I've done public speaking in front of large audiences. I do that a lot. And that doesn't really get to me anymore. At the beginning, obviously did. But there's something about knowing you get the countdown that you're going on live that like you just better step up and make it happen. And it's like those butterflies I still get. I've done it like 50 times. I still get it every time. Like it's very exciting.
Yeah. It's a lot of fun. It's for me though, now when I was doing it, it actually became pretty routine. Like I didn't really get nervous a lot. I was just more excited to be able to see everybody there. And when we do stuff, you guys are on camera all the time. So I feel like the more time that you spend in front of the camera, it just kind of becomes second nature. So.
Yeah, totally. Okay. So this hour flew by. That was a lot of fun. Steve,
I didn't get to anything I wanted to talk about, John. So we're gonna have to have you back next. Okay,
will you come back?
Of course, I'd love to.
Okay.
Yeah. At some point in time, John, because you're in coaching, I want to talk more about that. You're a coach as well. I wanted to get into that.
Well, would you want to get into that a little bit?
Here's something else that I like. I've got a list.
Okay.
John also spends a ton of his time, not real estate related, educating his clients financially.
Mm-hmm.
And I know that that's kind of where your heart lies because you've been through some trouble in the past with finances and you finally got your crap in order. So I almost feel like we should come back at some point and go through all of that because on our way back, Tom, this was funny. On our way back from the Kraken game, I was telling John all about how like my mom helped me get into a property and like the forced rent and all that stuff.
Mm-hmm.
And he was just like so excited about it. He's like, I can't wait to do that to my kid. Like financial planning. He had like, he was just like over the top. And you've actually extended that now to your clients, like helping them just simply break down things like budgets and the next level. And it's such a unique approach. And I don't know that we would have enough time to get into that. Cause I think we could spend another half hour on that and also another half hour just on coaching and the business model that you run, which is another topic that we missed, which is you don't do a lot of this stuff. You're like you're a dialer and a networker, which is different than what Tom and I do.
Yeah. I'd love to come back and get into the weeds on that, because that is for sure not a 5-minute conversation. So
No, for sure not.
I think maybe we turn it into that you just give us a full financial plan. I'll go over my real estate holdings, where my money is. Steve does the same, and you just rip us apart and you show us what to do.
He will, man. He would.
that would be fun. Well, that's like the teaser, right? So
yeah,
I'll see if we can hook some folks to come back.
Yeah,
all right.
man. Absolutely.
Amazing. John, thank you so much for joining us. This has been awesome. You represented the Americans very strongly. Great guest. We really appreciate you being here. For anyone that is listening or watching that maybe has family looking to sell in your market, or is thinking about moving there, maybe they're in Vancouver, they're like, you know what, it's time to make that jump. What is the best place for them to go to connect with you and your team?
Yeah, the easiest place, just go to our website, John By and Associates. You can Google us, check it out. John at John By is my email. You can get direct access to me there. JON at JONBYE.com. And we can help out anywhere in the States too. If folks are looking, even in Arizona, California, I know that most folks that are in Canada want to go to warm weather. It's still not warm here. So if you're looking for someplace sunny, we got great realtor partners all across the country, and more than happy to point them in the right direction.
I love it. Steve, final thoughts?
No, man. John, I love you, man. This is fantastic. I appreciate you coming on. We're going to do it again because we got a lot more to talk about.
Thank you. So part 1 has wrapped up. We'll be back for part 2. Thank you for listening. Thank you for watching. Have an amazing day, and we will see you next week. Bye.
Bye. Thanks, John.
All right, just give me a